the loophole didn't close. That's the part nobody tells you. Texas lawmakers stood in front of cameras and said they fixed the problem. They said the Housing Finance Corporation loophole was shut down. They said billions in property value would finally return to local tax rolls. And technically, they were telling the truth. But here's what the records show. The system didn't stop protecting elites. It just shifted the protection somewhere quieter. While cities were fighting to keep apartment buildings on the tax rolls, while mayors were begging lawmakers to stop tax revenue from disappearing, something else was happening behind the scenes. New exemptions were being expanded. Old taxes were being erased permanently. Entire categories of wealth were being placed out of reach, not temporarily, but forever. None of it illegal. No emergency hearings, no press conferences, no outrage. And that's what makes this story uncomfortable. Because when property taxes don't go down, when local services get cut, when homeowners are told everyone has to pay their fair share, the math never quite adds up. By the end of this video, you'll understand why. This wasn't a mistake. The housing loophole was just the loud one. The real story is what happened after it closed, and who Texas quietly decided to protect next. After the HFC loophole closed, most people assumed the damage stopped. Apartment buildings would return to the tax rolls. Cities would stabilize their budgets. Homeowners might finally catch a break under a story many viewers are encouraged to subscribe to on this channel. But that assumption rests on a dangerous belief that Texas lawmakers accidentally created a bad system and then fixed it. Because when you actually look at what passed next, you don't see a retreat from tax advantages. You see a reallocation. The benefits didn't disappear. They didn't shrink. They were redirected away from noisy housing deals and toward quieter, more permanent forms of wealth. And unlike HFCs, these changes didn't trigger outrage. No mayors held press conferences. No cities sounded alarms. Because this time, the losses were harder to see. In the same legislative cycle when lawmakers shut down traveling HFCs, they also passed a series of tax changes that barely made headlines. Here's what actually changed. Business personal property tax exemptions were increased from $2,500 to $125,000. Entire categories of intangible assets, stocks, trademarks, digital assets, were shielded from taxation. Corporate franchise tax credits were expanded, especially for research and development. And voters approved a constitutional amendment permanently banning any future estate or inheritance tax in Texas. Read that last part again. Permanently. Not suspended. Not capped. Locked into the Constitution. This wasn't a rollback of tax advantages. It was a hardening of them. Here's the difference between HFCs and what replaced them. When an apartment complex disappears from the tax rolls, cities notice immediately. Budgets break. School districts panic. Mayors start calling Austin. But when wealth is shielded at the asset level, there's no visible hole. No single building vanishes. No dramatic line item drops overnight. The revenue loss is diffused, spread quietly across millions of taxpayers, who never get a memo explaining why their share went up. That's why these changes didn't trigger outrage. They weren't loud. They were elegant. Texas already didn't have an estate tax. That wasn't enough. Lawmakers and interest groups pushed to make sure it could never exist, even if future voters wanted one. Even if future legislatures tried to respond to inequality or budget crises. By embedding the ban into the Constitution, Texas guaranteed that the largest transfers of wealth would remain untouched indefinitely. No matter how big the estate, no matter how many zeros, no matter how strained local governments become. This didn't help renters. It didn't help homeowners struggling with rising assessments. It protected something else entirely. But we're not going to name that yet. At this point, it's tempting to ask the obvious question. Is this corruption? That's the wrong question. Because none of this breaks the law. None of it violates ethics rules. And every change passed through the same legislative process: committee hearings, votes, signatures. Which means the real issue isn't legality, it's design. And in the second half of this video, we're going to look at who consistently benefits from that design and why the housing loophole was never the real problem. Once you stop asking whether these policies are legal and start asking who they consistently protect, the picture sharpens. Housing loopholes were messy. They triggered headlines. They angered mayors and school districts. They created visible victims. Asset-level protections don't. They operate above the noise, shielding wealth before it ever becomes taxable, before it ever touches a balance sheet that cities rely on. That's not accidental. That's design. Let's be precise. The expanded $125,000 business property exemption doesn't meaningfully help a corner store. It disproportionately benefits companies with large inventories, equipment fleets, and capital-heavy operations. The estate tax ban doesn't help 99% of Texans, because 99% of Texans will never leave behind estates large enough to be taxed. The corporate R&D credits don't go to startups operating out of garages. They go to profitable firms already spending millions and shielding intangible assets, stocks, trademarks, digital holdings. Protects wealth that never sits in a house, never drives on a road, and never directly funds a school district. This is wealth that floats above the system, while property owners stay anchored to it. When wealth is shielded at the top, the system doesn't collapse. It compensates. Cities still need to fund police and fire. School districts still need to operate. Infrastructure still has to be maintained. So the burden shifts. Not dramatically, not all at once, but predictably, to homeowners, to renters, through higher rents, to small businesses that can't move assets off paper. No announcement, no press conference, just a higher share of the bill. That's why property taxes feel permanent, because in Texas, they are. And this brings us back to the governor. When traveling HFCs became impossible to ignore, when cities revolted, when media investigations exposed billions bleeding out, Abbott didn't lead. He waited. No emergency declarations, no warnings, no calls for reform. He signed the fix after lawmakers passed it with veto-proof majorities, quietly. And when the legislature expanded asset protections, when estate tax bans were constitutionalized, when corporate exemptions grew larger and more permanent, there were no warnings either. Because from the governor's perspective, nothing was broken. The system was working exactly as intended. This isn't about Republicans or Democrats. It isn't about one bill or one loophole. It's about a governing philosophy that says, taxation should fall on what can't move. Homes can't move. Land can't move. Local businesses can't move easily. Assets can. Capital can. Wealth always can. Texas didn't eliminate taxes for everyone. It concentrated them. So when politicians promise property tax relief and homeowners keep paying more every year, it's not because relief failed. It's because relief was never meant to reach everyone. The housing loophole was closed because it was loud. The others remain because they're quiet. And somewhere in Austin right now, another exemption is being drafted. Another protection is being refined. Another shift is being prepared, not to stop taxation, but to decide who carries it next. That's how the system actually works. If this video helped you see the pattern, not just the headline, subscribe, because the next loophole won't look like the last one, and by the time it's visible the damage will already be done. Subscribe now to stay ahead of it.